Hi everyone. Me and my team today will be here to present about alternative investments. I'm Kim. My team are Nick, Anna, and Chintao. And today we will have a discussion on our individual adjusted portfolio where we had made asset allocations, and then we are going to make suggestions of other possible alternative investments or assets and also comments on each other's portfolio and talk about some future expectations as well. Now, my team will each explain their portfolio. Nick, you can start.
Now I'm going to start off with my portfolio allocation first. So basically, my asset allocation was divided into 60% on equities, 20% on gold, 10% on Australia bond, and 10% on Bitcoin. The reason of why I divided into this way is because, in my opinion, it is quite diversified as there's a mix of different asset classes in my portfolio, each with unique risk return, characteristics, and correlation to one another. To know more in details why I consider my portfolio is diversified, let's break it out. Starting off with both the equities, the S&P 500 and ASX 200. Investing in equities normally offers high return in the long term, and the reason I split my equity allocation between the US and Australian markets is to get the benefit from the geographic diversification because it can reduce the reliance on any single market. The reason I chose to invest 20% on gold is because it has a negative correlation with other asset classes like stocks and bonds, which makes my portfolio to be more diversified. And it is good to invest in gold when the market is in downturn position. And the next one is the 10% on the Australia bond. So I want to invest in Australian bond because basically the government bond is the safest investment and it has a low risk. The last one is 10% on Bitcoin. Bitcoin is quite risky in these days because it is very volatile and the price always change. But Bitcoin can offer good return in long term. And after I invest in all these assets and calculate it in 5 years data, my annualized average return is around 8.21%. And the risk that I have is 21.67%. You can continue to do portfolio B. This is my Kim.
Now I will explain briefly about my portfolio, as you can see in the slides as portfolio B. It seems that I'm not a big risk taker. I would like to preserve my money and would only invest safely. My asset allocation is more diversified compared to my teammates. I have allocated 20% each to ASX 200 and US 200 as the market represents a significant portion of the total market capitalization of the US stock market, which I believe is stable. And then I have allocated 15% to the emerging markets. This market offers the potential for high growth rate. It is more diversified and exposed to economies and companies in regions such as China, India, Brazil, and others. And then 25% in Aries is quite promising for future growth as it is based on income producing real estate assets. And then 20% in AUS bond is also investing safely as it is particularly government bonds. And as you can see from my annualized average return and standard deviation compared to the other portfolios, I can say mine is more on the less risk and compared to basically portfolio D is like it's very risky compared to the other three as well.
I have set up my investment portfolio in portfolio C, as you can see. Here's what it looked like. ASX 230%, Australian bonds 25%, US S&P 500 20%, AREITs 50%, and MSCI 10%. Let me explain why I put my money into these areas. I chosen the ASX 200 and Australian bonds because they are stable and can help bring in regular income. The US S&P 500 give me a stack of global stocks and help spread out my investments. AREITs let me invest in Australian property, which I think will grow and give me income. Lastly, the MSCI index helped me spread my investments around the world. Overall, my portfolio has been making about 5.76% each year on average. It's not too risky either, with an average fluctuation of 16%. I'm open to talk more about why I pick these investments and hearing about the other option from portfolio safety.
Hey guys, I'm Jintao and my portfolio is the last one. It has generated the highest return of 10.9% with the highest risk as well of 24.85%. It consists of S&P 500 for broad market exposure, 40%, Bitcoin for its high growth potential, 25%, ASX 200 for some Australian diversification, 15%, Australian Real Estate Investment Trust for income and real estate exposure, 15%, and a touch of gold, 5% as a potential hedge. Now you might notice the heavy allocation to Bitcoin. Here's the thing, I am 21, unmarried, and come from a family with some financial background. That means I have a high risk tolerance. It's not that I have nothing to lose exactly, but my financial safety nets allow me to take calculated risk in pursuit of maximizing return. My goal is to build wealth for that early retirement or maybe even start my own business someday. That being said, I'm still learning right now and I'm curious to hear your thoughts, especially on the potential drawbacks of my Bitcoin investment, considering its historical volatility. So now let's compare our four portfolios. We have all clearly chosen different paths reflecting our unique goals and risk tolerance, but there's also some interesting commonalities. So, Nick, can you start the discussion by pointing out the major similarities and differences you have observed across our portfolios?
So I think the differences between us is I think most of you didn't invest in gold
Mhm.
because I think gold is safer in terms of investment in when the market is not in a good position. So yeah,
We got the similarities of the S&P.
I think we all have the same equities investment, the S&P and ASX.
Yeah, I think those are pretty good. Like the return from ASX 200 and S&P 500, both market has been like generating pretty good return overall. So I'm not surprised with that. But yeah, I agree with you with gold one because I thought everyone gonna have gold in their portfolio, just like mine, at least 5%, but that's surprising.
Yeah, and also I'm quite surprised that you have quite a big investment in Bitcoin because these days Bitcoin is very risky. Even though it generates a high return in the future if you get it right.
When I look at this portfolio, I feel like me and Kim are more like a lower risk
Yep.
than Nick and Jintao. It was like higher risk and stuff like that.
Yeah, I agree on that. Like I think
It's
my
more
portfolio is like the most aggressive of all, and Kim's and Anna's portfolio B and C are like the safest portfolio here, and Nick's
Yeah.
portfolio is quite diversified.
more balanced,
Yeah.
I think.
Yeah.
Nick is more like his allocation spreads like investments across like various assets classes because it includes like stocks and gold bonds and also like cryptocurrency.
Yeah, so in my portfolio, they have some risky investment, but they also have some safe investment like the bonds and the gold, right? So yeah, I think it's more balanced.
Oh, I also want to point out like the reason why I put like so much in Bitcoin, specifically because there are a few reasons. Like the main reason is because I believe in Bitcoin. I feel like I'm pretty young and Bitcoin to me is kind of the goal for new generation. So to me, I believe in the system itself. And recently they approved the Bitcoin spot ETF in the US. And Bitcoin also have some similar characteristic to gold, like the limited supply. And the Bitcoin halving will push the price up. So I expect the price of Bitcoin to go up a lot. That's why I put like majority of my investment, 25% in Bitcoin.
Yeah.
And I
Okay,
was
good.
wondering why in like portfolio A, so his diversification, it can help mitigate risk associated with any single asset classes. But I also wanted to point out that there is no allocation to the real estate assets because I believe it's continuing to evolve. Its future growth prospects, it remains promising. And according to the Australia Survey of Real Estate Investments Trust, the global REIT market is projected to reach a staggering like 5.8 trillion by 2030. It's the compound annual growth rate of 7.1 during the forecast period from 2023 to 2030. So that's why I thought that real estate market would establish as a crucial component of one of the investments that you might consider as well?
Yeah, I think so because when I see the other portfolio, you guys have invest quite a lot in the real property.
Yeah, because it's significant portion of their taxable income is considered as dividends, so it kind of provides the investor with a reliable income stream as well. So it's quite promising if you wanted to like invest in that market.
Or shall we continue to the alternative investments?
Yeah, let's
we-
continue.
Before we jump into our recommendation of alternative investment, I think we need to know why we need to add the alternative investment in our portfolio. Because based on this chart, when you don't put the alternative, I think the risk and the return is more like if you put bonds more than stocks, then you have less return, even if it's less risky. And if you put more stocks than the bonds, then it will be more aggressive. But if you add the alternative investment in your portfolio, I think it's much better. It will reduce the risk and probably can get higher return. So alternative investment is very important to add in your portfolio. We're gonna discuss like some alternative investment recommended by each of us, starting with silver by Kim.
I wanted to point it out silver specifically because even though gold is a pure hedge against the economy and stock market, silver offers a wider array of safer, reputable places to invest. But could just be based on risk tolerance as well. If you wanted something safer, it is because it's used more in the industry, whereas it's needed in electronics, solar panels, medical devices, and photography. Um, Silver is less costly than gold based on Business Insider. In the 21st century, its spot price in the financial market has never exceeded $20 an ounce, while gold trades in four figures. So the same dollar investment buys you a lot more silver than gold. And the market is smaller than gold because it's more thinly traded than gold, and it can be demonstrating greater price swings like leaping 13% in a single day. Investors can invest in silver through EFTs or mutual fund that bundles together multiple silver related assets through brokers or trading apps or through the investment companies that sponsor them. But there's also exchange traded notes and exchange traded commodities. They offer complex yet diverse silver-centric investment avenues. And then prominent examples where you can trade in silver includes Velocity shares, long silver or iPath, silver ETN, and so on. But despite being affordable and having numerous industrial applications, silver has not received as much attention as gold. Only 15% of the market demand comes from investors, while the majority is driven by industrial uses. This indicates that silver is not widely owned by investors and is potentially undervalued. Additionally, compared to gold, silver is relatively inexpensive, providing investors with greater opportunities for purchasing.
The alternative investment that I choose to add in my portfolio is hedge fund. So basically, hedge fund is a range of investment strategies that can provide diversification benefits beyond the traditional asset classes like bonds and assets. In my opinion, I think it is good to invest in hedge fund because you can choose a specific strategy that can mitigate the risk and increase the return. Hedge fund, you have an expert that can help you to mitigate the risk, and I think it's very good in when you want to get a higher return in the future. Like for example, the company, the Bridgewater Associates, the hedge fund strategy that they use is to focus on the micro problem. Like they ask the expert to predict the interest or the geographic condition, like to predict whether it's a good or not, to predict and probably get a good profit in the future. The next company is the Renaissance Technologies. It's a computer technology, and the hedge fund strategy that they use is to focus on the mathematical strategy, like to predict the future price. Yeah, and the reason I add my hedge fund in my portfolio is because I have quite a lot of risky investment. So I think I need a strategy to mitigate that risk and increase the return in the future. And yeah, that's all for my alternative investment. And let's continue to the infrastructure by Jintao.
Hi, so as you all know, my portfolio is pretty aggressive. I have high risk tolerance, which is reflected in my return, but also in the volatility. While I'm aiming for the maximum growth, I've been thinking about ways to add some stability without completely changing my strategy. So I've been researching infrastructure as a possible option. Infrastructure refers to the essential assets that keep an economy running. Think of it like roads, power grids, airports, that sort of thing. You can see in the picture here. There are a few reasons why it might be a good fit. One is the diversification. So infrastructure often doesn't move in the same direction with the stock market, so it could potentially smooth out some of the ups and downs in my portfolio. Secondly, the income. A lot of infrastructure companies pay steady dividends, adding a bit of income to my current growth focus. And another reason is the inflation hedge. Some research suggests infrastructure can act as a partial hedge against inflation, which is something I should be considering. The easiest way for most of us to invest in infrastructure is through specialized fund or ETF. I found one ETF called iShare Global Infrastructure ETF, or in short, IGF. It invests in a mix of utilities, transportations, and energy infrastructure companies worldwide. I also want to point out that the infrastructure sector has provided investors with pretty strong return over the past decade. For the last 10 years, the listed infrastructure sector has delivered around 9.5% per annum, while unlisted infrastructure deliver around 11.4% per annum, according to Maple Brown report. That's it from mine. Let's move on.
Here is why I think private equity is a good idea first. Private equity can make us more money. Usually it does better than regular stocks in the long run. That's because we can help the companies we invest in do better. And there's a special bonus for investing in things that aren't easy to sell quickly. Second, it can make my portfolio safer. When the stock markets go down, private equity doesn't usually get affected as much. So it's like having a safety net for when things get rocky. Also, private equity let us invest in cool stuff we can't normally buy on the stock market, like maybe there's a new tech company or restaurant chain that's not public yet. Investing in private equity gave us a chance to get in early and maybe make a lot of money. But there's also things we need to think about. Private equity isn't easy to get rid of quickly. Once we invest, our money might be stuck for a while, and it takes a lot of research and know how to pick the right company to invest in. So adding a little private equity to my portfolio could be a good move. It might make us more money and help us to stay safe when the market get bumpy. But we need to be careful and do more research before jumping in it.
I think now we can discuss about the expected return for our alternative investments that we have talked about. Since I'm very bullish on US stock market, the S&P 500, historically the market has been generating us around 10% per annum, roughly, including dividends. So it honestly is very high, and I think over like a long-term period, no one has ever lost money in the stock market, in the US stock market, if they invest like long-term, maybe over the periods of 30 years or something like that.
And for me, I want to comment about the gold because I invest quite a lot in gold. And when I see the prediction in the future, gold is the price of gold is become increasing in every year. So I think investing in gold is very good.
Another one I want to point out, like Rolex watch, right? That one we haven't talked about it yet, but to me it's like very interesting, like the watches market, because I know like some people who invest quite heavily in the watch market, they have like a lot of Rolex watch. So the return on that is honestly pretty good. Like I did some research and then they say like the return is roughly 10%. So that's even more than the real estate market and gold and other equities and stuff. That's pretty interesting.
Thank you for listening and hope you enjoy it.